Hi, this is Jim Cunningham. We're going to talk about the LLC Advantage liability protection. That's the biggie. That's the one that most people are looking at when they look at setting up an LLC, or in large part, they're looking for some type of liability protection. We live in a very litigious country. We live, I think most of the lawsuits in the world by far are filed in the United States. The last figure I heard was more than 90% of all lawsuits in the world are filed in the United States. And liability is a real issue. So certainly if you're a business owner, if you own real property, if you've got maybe some investments that might be kicking off potentially some liability, it's really something important to consider. We're going to cover what is asset protection, what exactly are we talking about, and when, how, and why can you use asset protection, or, why is it even available to us, right? So we hear a lot of people say, oh, asset protection, I'm going to break through that asset protection strategy. And sometimes people are able to set aside those strategies. They're able to unwind those. And we're going to show you ways that really do work. Now, they don't work to eliminate all liability, but certainly containing liability is a big theme that we'll talk about. So if you have 5 rental properties, you don't want one rental property to take down the other 4 and your personal assets as well. So we'll be talking about that. And we're going to talk about the interplay between LLCs, partnerships, and corporations. And a little bit of a spoiler alert, why do people hold real estate in a partnership or LLC typically and not a corporation? It's because when you die, you do not get an adjusted cost basis on the assets inside of a corporation. So stated another way, when you have a capital asset, most capital assets like real estate, even equipment potentially, most of those are placed into some type of partnership or LLC. Sometimes an LLC can be taxed as a partnership, but we'll get into that. And then we're going to give kind of the use case of an LLC and why that makes sense. So a very important, a disclaimer, I'm a lawyer, I'm talking, my lips are moving. This is by no means legal advice. And as you're going to see, it's very easy to set up an LLC. In California, you can go onto the Secretary of State's website and set it up. I'm not going to really walk through how to do that. I'm just going to talk about the benefits of an LLC. And really, if you do have something to protect, it does make sense to involve an attorney, not just a service provider or other non-attorney. If you're watching this on YouTube, please subscribe to our YouTube channel. And if you have questions, please go ahead and post those questions in our comments, because I personally look at those questions and do answer those. So you're also welcome to join one of us on our live webinars. This happens to be a live webinar that we're recording. And if you're watching this on YouTube, this is live. There's a bunch of people watching right now, and we do a Q&A at the end. So I really encourage you to go to our website and sign up for one of our webinars so you can participate in that Q&A. These are the attorneys in our firm. We are dedicated to all things peaceful transfer of wealth from one generation to the next, individuals and business owners. So that is really what we're primarily focused on, is the business owner, whether you own a real estate portfolio, an operating business, or maybe have portfolio income, you have a lot of investments. We are there to help people transfer that wealth, minimize taxes while you're alive. Our firm is centered around that. I'm Jim Cunningham. I'm the CEO of Cunningham Legal. I have 30 years experience as an attorney, a little bit over 30. We have offices throughout the state of California. I'm a certified specialist in estate planning, trust, and probate law, and currently am involved in the recertification process. So when people seek to be certified or seek to be recertified, I'm one of the people involved at the California State Bar to make sure that goes smoothly. I'm also a real estate broker, securities, and insurance licensed. I'm also a pilot, single engine land, instrument rated. I am not current, however. Well, let's talk about what is asset protection. It seems pretty straightforward, right? It is a component of financial planning. So asset protection is integrated with other things. It is not something where you say, I'm going to sign this document and my assets are protected. It doesn't work that way. It's part of an overall plan, and many times the plan that you create has asset protection features in it, just native to the plan itself and the way that an LLC might operate. There are built-in protections that serve an asset protection function. So we're going to be talking about asset protection within the context of LLCs today. We do cover on other webinars and other videos. We have covered asset protection using trust, and we'll touch briefly on that, but we're going to be focused today on LLCs. Asset protection is designed to protect assets from creditor claims. Now, this is not just any creditor claim, because some creditor claims, as you'll see, they're going to get the assets. They might be able to get an asset inside the LLC, for example, if there's a liability arising from the LLC. Now, that would be inside liability. But what we're really talking about here primarily is outside liability. It's designed to protect people from going after your personal assets. Individual and business entities use asset protection, these techniques, to limit creditor access to certain valuable assets. Now, what you're putting in there has to be some value to it, right? Otherwise, it's not worth protecting, while operating within the bounds of debtor-creditor law. This is very important. So there's a lot of law out there. There's a whole federal bankruptcy court that deals with insolvent individuals and business entities. Debtor-creditor law is a big component of the law, quite frankly, because people, right, a creditor wants to get paid. So there are a lot of cases on this. There's a lot of law on it, but it has to operate within the bounds of those. And sometimes people step outside of the bounds and then they get in trouble. So let's give an example here of Rancho Fuego, which and Rancho Fuego means, fire ranch in Spanish. But what this is Oscar owns the shares of an LLC that owns a ranch called Rancho Fuego. Now, what this means is Oscar has an LLC. He holds paper shares, and the LLC is on title to this ranch. So the LLC is the one that owns the dirt, the bricks, the sticks, the fencing, maybe the equipment, has all the assets. So the LLC has the assets. Oscar holds shares. You can think of this as membership interest or membership units, shares in this LLC. Romeo, the ranch hand, is clearing brush while using a controlled burn. The controlled burn gets out of hand and jumps to the adjacent ranch, burning structures and causing other damage. The neighbor successfully sues and goes after the LLC shares owned by Oscar. Oscar's other assets are not available to satisfy the neighbor's claim. So what you have to understand here is this is about limiting liability to the assets of the LLC, the Rancho Fuego assets. And this is a lot of times how it works in California is the LLC would be sued directly. The LLC would be liable for the judgment. In the event that Oscar cannot pay that judgment, then a creditor could foreclose on those shares. And that's kind of how that works. So a bit of a process there, but something to understand is this protects Oscar ideally from personal liability, so long as he's not actively participating in the burn. And also the next question is, does it protect his other assets? And we'll see California is very creditor friendly, very debtor unfriendly, whereas Wyoming, as we'll see at the end of the materials here, is very debtor friendly and very creditor unfriendly. So there's a workaround on this that we'll cover at the end. So what isn't asset protection? It's not doing something after you're sued. It's not doing something after the fire starts on Rancho Fuego. This is not insurance. Insurance is designed to pay a creditor, right? Or to pay you, right? If you have a loss, but in this context, to pay a creditor, so they don't otherwise take your assets. So insurance, and this is very important because some people say, I don't need asset protection because I have an insurance. It's not an either or. I really think it's a yes and. And let me tell you why. Insurance has a three-pronged test. But before we get there, an attorney worked for me many years ago, and he said, Jim, the first job I had out of law school, I was at an insurance defense firm, and every day one of the senior partners would come in and he would put a claim on my desk and the policy on my desk, and the instruction from the senior partner was figure out a way that the insurance company that the firm represented does not have to pay on this claim. So insurance companies, what are they really good at? They're really good at collecting your premium. What are they not good at? They're really not good at paying out claims. Like, they're in the business of collecting premium and holding onto that money and getting really rich. They're not in the business of handing out settlements, and they're not in the business of handing out money, right? Not a shocker to anyone watching this. But insurance does have a three-pronged test. Time. Typically, an insurance policy is for a period of 12 months. That's very common. And it's in these 1 year increments. So it is good for this year. It is not good for last year. It's not good for next year. Policy limits. This is the maximum amount an insurer, the insurance company, is contractually obligated to pay if they determine the event is covered. And what if they don't determine the event is covered? Well, you got to sue them, right? So they may say, well, you're not covered. Right? We didn't cover controlled burns. If you read on page 98 in the fine print in the 6-point boilerplate type, we don't cover controlled burns. Sorry, Oscar, you're out of luck. And then so there's time. It's a year. There's policy limits, right? So the amount that the insurance company will pay, and then there's coverage. This is really, really important. So insurance companies will not pay will not pay on a policy if the event is not covered under the terms of the policy. So example, if there's an exclusion for a controlled burn, they're not going to cover that. So time, policy limits, dollar amount, and coverage. It's within the time, it's within the policy limits, but sorry, Charlie, you're not covered. So a living trust provides no asset for the creator. It's very important to understand if Oscar puts the ranch into a living trust, that provides no creditor protection for Oscar. Well, let's look at Charlie's car accident. Alpha and Bravo. And by the way, if you're having, we had a comment, look at the comments. People say, you have weird names in here. We have weird names intentionally so that you're like, well, that's kind of an odd name. So you kind of know who the players are. Alpha and Bravo have a son, Charlie. Charlie's driving a car owned by Alpha and Bravo. This is a very common situation. Alpha and Bravo, they've got this kid starts driving, and they give one of the cars that they used to drive. Here's my 18-year-old car. I'm going to go buy a new one. Here, Charlie, have at it. Be careful. Charlie's in an accident, and it's Charlie's fault. Alpha and Bravo have a $500,000 auto policy and a $3 million umbrella policy. After the trial, the damages are determined to be $1 million. The auto policy pays the first $500,000, and the umbrella policy pays the next $500,000. The creditor gets money, and the insurance company pays it. Now, this is very important. If you do not have an umbrella policy, you absolutely need to look at this. So just call your property and casualty person, but really you should consider an umbrella policy because many auto policies are capped at $500,000. So it's just something to pay attention to. And, God forbid you make Alpha and Bravo make Charlie pay his own insurance and he gets the minimum, right? Alpha and Bravo own the car. They're potentially on the hook under a theory, what we call negligent entrustment. They knew Charlie was a crummy driver and they lent him the car anyway. What do a lot of people do? What's the estate planning fix for this? Put the car into Charlie's name. Alpha and Bravo can be a lien holder so that Charlie can't go ahead and sell that property. So Alpha and Bravo can transfer title to the car to Charlie, and Charlie can be a lien. Alpha and Bravo can be a lien holder so that Charlie just can't go sell the car out from under Alpha and Bravo and Charlie. Let's talk about outside liability versus inside liability. Outside liability is really best described as personal liability. So inside liability is best described as the business liability. So a liability that arises from the business activities. In our example that we've already gone through, Rancho Fuego, with Romeo starting the controlled burn, that is an example of inside liability. Alpha and Bravo letting Charlie drive the car is an example of outside liability. If the coverage was $3.5 million, but the judgment was for $10 million, that $6.5 million difference might be on Alpha and Bravo to pay. Okay, so if there's a judgment beyond the policy limits, Alpha and Bravo have personal liability, and then that creditor may be able to seek recovery of those funds from Alpha and Bravo's personal assets. So just understand, inside liability is liability that arises within the activities of the business itself. Outside liability is something that happens someplace else, but the owner of the shares of the LLC has some type of liability totally unrelated to the underlying business that this particular person who owns the LLC shares, right, the creditor in this case, totally unrelated to the business. So that liability unrelated to the business. And again, Alpha and Bravo have a son, Charlie. Charlie's driving a car owned by Alpha and Bravo. Charlie's in an accident. Alpha and Bravo are personally liable because they own the car and entrusted it to Charlie. Negligent entrustment is what is called a cause of action, or something you can bring a lawsuit for in California. Even though Alpha and Bravo aren't driving, each of Alpha, Bravo, and Charlie are personally liable. The injured party can seek recovery from the personal assets of Alpha, Bravo, and Charlie. Of course, Charlie has nothing. Alpha and Bravo have all the assets. So that's really important to close the loop on that. Put Charlie on title, and Alpha and Bravo can be a lien holder. That's one shortcut. And we'll see there's some other asset protection strategies we'll get into later. Again, inside liabilities is Oscar with Rancho Fuego. Ranch hand starts a controlled burn. The controlled burn gets out of hand. It's inside liability because the liability arose from the activities of the business, right, of running the operations of Rancho Fuego. How can companies use asset protection? So how can business owners, how can companies use asset protection? Well, there are different types of business organizations. So if you're a business owner and you're watching this webinar, you may say, oh my gosh, there's a lot in here. Whoa, my brain is already full. I hate to say it, but you're going to need to make a little bit more room, because there are really 4 types of business organizations that we're going to talk about here. One is the sole proprietorship. That is where Jim gets a lawnmower and a pickup truck, and I knock on a neighbor's door and I say, I'll mow your lawn for $50. Great. I haven't set up a corporation. I don't have a any kind of business. When I file my 1040, it goes on my Schedule C. It's my activities as a human being working in the world. A partnership is where I say, hey, Art Vandelay. Any Seinfeld fans out there? Jim and Art start a lawn mowing business. Hey, Art, why don't you work with me and we'll work together. I'll supply the truck and I'll supply the lawnmower, and we'll mow lawns, and we'll just split the money 50-50 after you pay me some rent on my truck and my lawnmower. That's a partnership. That does not require a filing with the Secretary of State. It's not required. You can file with the Secretary of State. That happens to be a general partnership. So me and Art, we start mowing lawns. We have an oral agreement. There's no agreement in writing. That is a general partnership. If Art runs over a kid with the lawnmower, we are general partners. I am 100% personally liable for everything that Art does within the context of the furtherance of the business purpose of the partnership. So meaning we're general partners in this lawn care business. Art runs over a kid with the lawnmower, or injures the kid horribly. I am personally liable for that, okay, because it's a general partnership. There are limited partnerships that require a general partner and a limited partner. So maybe Art could be the general partner. I would be a limited partner. And I run over somebody with the lawnmower. Art is on the hook 100% because he's a general partner, but maybe there's another limited partner in there that's not liable. So they just lose their capital. I don't want to get in the weeds on this, but where I am going with this is LLCs, because LLCs really make things a lot easier. A corporation, it requires a filing with a particular state. So California, you file at the Secretary of State, you file your articles of incorporation, you get your corporation formed. There are more formalities with a corporation. So a corporation does require an organizational meeting, bylaws, issuance of stock. It requires a lot of formal type things. And there's S&C, just as tax status. Big companies like Apple or C Corps, small companies like if Art and I create a corporation to mow lawns, it's going to be an S Corp, meaning the corporation doesn't pay tax, but we pay that individually. And then there's the LLC. The LLC was created first in Wyoming in the United States in 1977, and the LLC really blends the best of sole proprietorship, partnership, and corporation. It's very important to understand that the term LLC does not have anything to do with taxes. So when people ask me, when I ask people, what's your business? They say it's an LLC. I'll say, well, how's it taxed? They say it's taxed as an LLC. Well, an LLC can be taxed in 4 different ways. An LLC can be taxed as what is called a disregarded entity, which means it's like a sole proprietorship, but you have creditor protection, right? You have all that liability is limited to the assets of the LLC. There's a partnership. So an LLC can be taxed as a partnership, but you need at least 2 members, right? So if it's just me and mowing lawns, I can't be an LLC taxed as a partnership. But if I'm mowing lawns with Art, we could be an LLC taxed as a partnership. We have limited liability. Okay, it's in the name, limited liability company. That's different than the general partnership. Or an LLC can be taxed as a corporation, whether it's an S or a C corporation, but an LLC can be taxed as a corporation, and there are different use cases on why they're taxed as a corporation or a partnership. I don't want to get too far in the weeds. I just want you to know that an LLC can largely replace corporation, partnership, and sole proprietorship, and whether it's a disregarded entity, partnership, or corporation is handled on the operating agreement level, right? So you form your LLC at the Secretary of State's office, and then in the operating agreement, you define whether it's a partnership or a sole proprietorship or a corporation. Why is it important to have an entity? So Alpha and Bravo are general partners in a business that makes ube flavored ice cream. Echo is driving a delivery van, is rear-ended by a drunk driver, pushing Echo into a van carrying 10 doctors, all of whom become paralyzed. Okay, so Alpha and Bravo, general partners, they just said, hey, let's start making ice cream and let's hire Echo to deliver ice cream. Even though Echo is deemed 1% at fault, and this is California, you need to understand these types of rules. Even though Echo is deemed 1% at fault, Echo and Alpha and Bravo, right? Because they own the truck. Maybe they negligently entrusted it to Echo. I don't know, right? All of them are jointly and severally liable for the special damages, which is the future medical bill. So pain and suffering is general damages. Special damages is very unique to the law. And what that says is medical, these 10 doctors were all paralyzed. They're going to need certain handicap accessible vans. They're going to need all kinds of medical treatment. They're going to need things related specifically to the damage. If a person is 1% liable, they are jointly and severally liable, meaning if the damages are $100 million, Alpha and Bravo and Echo are each liable for $100 million. Okay. Now, if Alpha pays $100 million, Bravo and Echo, that the judgment's been satisfied. But my point here is just because you're only 1% at fault doesn't mean that it cannot be a really big judgment. And this is why people seek asset protection if they run a business. So if you're running a business as a sole proprietor, I would say you're probably taking excessive risk, probably, right? Medical bills in this case exceed $300 million. Alpha and Bravo are each 100% responsible. Not a good outcome. Now, what's a better outcome? Alpha and Bravo create Yummy Ube Inc. And Echo is an employee of Yummy Ube Inc., delivers a ube flavored ice cream in a van leased by Yummy Ube Inc. Remember leased, right? So it's just a rent payment that's going out. Echo's rear-ended by the drunk driver who pushes them into the van carrying 10 physicians, $300 million in medical bills. These damages are recoverable only from Yummy Ube Inc. and not Alpha and Bravo personally. So this is very important. So many times clients will have their operating company. Yummy Ube Inc. is the operating company, and we use a corporation. You could have Yummy Ube LLC taxed as a corporation. But just to make it clear, clear as mud, right? Yummy Ube Inc. Is the operating company, but you may have Yummy Capital that owns the truck and leases it to Yummy Ube Inc. And so there are use cases. This is why you see people separating the capital assets like the truck from the operating business, because you are protecting those assets from liability. So what is a limited liability company? Really good question. A limited liability company is a type of business structure that can combine the asset protection features of a corporation and the tax benefits and flexibility of a partnership without having to create a limited partnership, which it's just a lot more complicated. You have to have one general partner. Oftentimes it's a corporation for 1%, and then 99% of the shares are limited partnership shares. The LLC taxes a partnership. Kind of eliminates that extra entity you have to create. And so it's a much more efficient way of getting partnership level or partnership taxation treatment and limited liability without having to take a few more steps. The LLC can be an effective vehicle for real estate investing due to its flexibility, tax advantages, and liability protection. So think of an LLC like Las Vegas. What happens in Vegas stays in Vegas. If mom is sued for the fire that starts on the property held by the LLC, her liability is limited to her equity position in the LLC, right? So as long as mom's not the one starting the fire, okay, as long as that fire doesn't start by her own negligence, because you are always responsible for your own negligence, right? Maybe it just starts spontaneously. Maybe it starts, maybe a worker, right? Like we had in our Rancho Fuego example. But again, mom is always responsible for her own negligence. So advantages of LLCs: ease of transfer, fewer corporate formalities. A corporation, you have to have not only do you have to set it up with the Secretary of State, which you do have to do with an LLC, it is not valid until you have your bylaws are signed and your stock is issued. LLCs have no requirement to have an operating agreement. An LLC, those are kind of like the bylaws of an LLC. There's no requirement to have an operating agreement, although we do recommend, you're not going to be able to open a bank account without at least a corporate resolution or some type of operating agreement, realistically. But they're not required to have an operating agreement. And A lot fewer. You're not required to have annual meetings like you are in a corporation. By the way, if you don't have your annual meeting in a corporation, you lose potentially your limited liability. Also, California, there's a minimum franchise tax in California, which is $800, which I have LLCs, and when I have to pay that on an LLC that's not generating any money, it really annoys me. It annoys every single client to pay $800 a year just to have an LLC. And some clients say, well, I'm just not going to pay it. Well, they're going to catch up with you at one point. But also, it's really important to understand, if you don't respect the laws of the state of California, and then you ask a judge to respect the laws of the state of California to protect you in an asset protection situation, good luck with that one, because I have heard judges say, if you don't respect the laws of the state of California, you're not protected by them, and period, right? So it's very, very important. You need to pay those minimum franchise taxes. An LLC provides for flexibility, management and ownership flexibility of distributions, when and how and who gets what, and that's kind of native to a partnership structure. Liability and asset protection, it protects owners' other assets from LLC liability. So if an LLC arises in that liability, it's contained to that liability, provided that the owner is not personally at fault. It is a great tool for multi-generational wealth planning. So if I have an LLC and I've got a property in that LLC, and let's say I want to give 30% of that property to my kids in a dynasty trust, and we talk about this in other webinars, I can make a transfer of that wealth. It gets discounted for gift tax purposes, and I still control it. It's a pretty good deal. And that 30% interest maybe goes to the kids, and it's taxed as really, if it's a 20% interest, maybe you get a 1/3 discount, thereabouts. I don't know. If it's done right, it's not free. It takes a lot of work. It takes you have to get valuations and work with lawyers and CPAs and valuation experts, but it's a really effective way for people to transfer wealth and yet still maintain control, to transfer it from one generation to the next. Pass-through taxation and tax benefits, business deductions and specific taxation. We're going to cover this, certainly with the pass-through entity tax in California. Paying that tax. So paying that tax at the corporate level gives you a federal deduction. And California is one of the only states where that works. So yes, we pay a lot of tax in California, but we can effectively get that rate down if the business activity is happening in California or you're a California resident. So LLC and real estate, the LLC owns the property. So instead of you owning the property directly, you own shares of the LLC or membership units or membership interest, whatever, however you call it, but we'll just call it shares because that's kind of what most people understand. What are the benefits? You take real estate, so you have an apartment building, you put that into an LLC. Benefits include flexibility. You can appoint a manager to handle the affairs to handle the property. If you're on title, if Jim is on title of this property and you need to evict somebody, I'm going to have to be signing the eviction papers because I'm the owner. If it's unless I have a management agreement, but if it's in an LLC, then the manager of the LLC would sign those eviction papers. Lack of corporate formalities, we discussed that. Not the same rigid formalities of a corporation. So I would say an LLC for those reasons is frankly less legal fees many times, just sort of the annual compliance work that you have to do. Creditor protection, this is very, very important. Certainly if you're a single member LLC, probably a little bit less creditor protection. If you're a multi-member LLC, probably more creditor protection, right? So if there are more people in there, you have a better argument. So that's just in terms of the spectrum of what is a stronger asset protection vehicle or not. Anonymity. This is a biggie. If the LLC owns the property, nobody knows that I own the shares of the LLC. Now, the fact that I manage a California LLC is a matter of public record. So you can see who the manager is, but you do not see who the owners of the LLC shares are. So that remains private. The downside, this does require some care and feeding. I did mention the $800 a year minimum franchise tax, as well as, potentially a tax return, additional tax reporting. But on balance, I think most people who own real estate, on investment level real estate, most people are looking at the LLC. Not everyone chooses to move forward with it, but many people do. Why an LLC? So what is a use case for an LLC? Personal asset protection, very strong. If it's in your name or it's your activity, no creditor protection. Very important. You're always liable for your own negligence, and you're liable for the acts of your agent, right? You're personally liable because you have hired maybe you hire Oscar or you hire Romeo to work at Rancho Fuego, if you hire Romeo and he does something wrong, you're responsible for Romeo's actions. If the LLC hires Romeo, then the LLC is responsible. You're just the manager, right? And you own the shares. So it gives you this layer of protection. Corporation, I would say, has a similar asset protection in this sense of an operating business, although you do have some formalities that go with that. So a lot of our clients, for an operating company, they might have an LLC that is taxed as an S corporation versus doing an S corporation. Okay, just to give you a little bit of heads up on that. A little bit easier. Personally, if you're a lawyer, you cannot use an LLC for a law firm. If you choose a corporate structure, you have to use an S corp. But for any other type of operating company, you can use the LLC taxed as an S corp. Flexibility in LLC, you can choose how you're taxed: sole proprietorship, partnership, corporation. Sole proprietor, really none. It's just tax goes on your 1040 Schedule C. And with the corporation, can get pretty complex, but it's rigid. It's always corporations are always taxed as a corporation. If I am partners with Art in our lawn mowing business, and we are a partnership, let's say we're an LLC taxed as a partnership, I can say, Art, you did a lot more work than I did this year. So why don't you take 75% of the profits and I'll take 25% of the profits? If it's a corporation, when it comes time to make a distribution to shareholders, if I own 50% and Art owns 50%, Art must take 50%, I must take 50%. That's just the way it is, unless Art takes more W-2 comp. That would be a sort of a backdoor way of getting Art more money, but he may not want the W-2 comp for a lot of different reasons. So I would say in that sense, it is less flexible. Partnerships, far more flexible. Setting up an LLC is rather simple. You file it at the Secretary of State. Sole proprietor, simple. You don't have to do anything. You just, go get some cards. I just pick up a lawnmower and my pickup truck and I start mowing lawns. Corporation, very complex. Okay. You have to, not only do you have to form it in the same way you would an LLC, but you have to have additional steps. You have to get the bylaws created, signed, have your organizational meeting. You do have to have annual meetings, and the shares of the stock must be issued to shareholders, so at least one shareholder. So LLC is ideal for a small business, real estate investors, and families. Sole proprietor is good for the side hustlers, right? Just someone with a lawnmower and a truck. And a corporation is good for larger operating companies. You might have legacy companies. You might be stuck with the corporation. If grandpa had some farmland in the 1950s and put it into a corporation, there were no LLCs in the 1950s. If it was just grandpa and he had no partner, he couldn't do a partnership. And there were only C corporations. We didn't even have S corporations. So a lot of our farming families have this legacy property in a C corp. It's not the end of the world, okay? Because many families are never going to sell it, so it kind of doesn't matter. The basis of the property, you're not depreciating the property anyway. But if you're a big landowner, ag landowner, this is probably sounding familiar that somebody or someone's grandparent did this. Maybe now great grandparent, right? Put that property into a corporation. LLCs do protect personal wealth. It separates the business from the person. If the business gets sued, your home savings and investments are off limits. That is the idea. If a liability arises that is not your personal liability, and I keep stressing that, right? These lawsuits, they do happen. Employees slip up, customers fall, tenants sue, and you don't want your personal assets exposed. You want the liability limited to the assets of that particular LLC. LLCs contain business liabilities. If something goes wrong inside the business, contracts, employees, again, accidents, the LLC takes the hit, not you. There are some carve-outs for this where individuals are personally liable in the labor law space and some other areas. But broadly speaking, the idea is to contain the liability to the assets of the business. This keeps the fallout inside the box, this LLC box, instead of spreading like wildfire throughout your personal finances. LLCs, again, enjoy tax flexibility. We've talked about the disregarded entity, which is very simple. Meaning disregarded entity, you do file a California state return. You are not filing a separate federal return, all right? So you're still reporting that on your federal 1040, typically your Schedule C. Partnership, this is really great for more than one person. You can't be an LLC taxed as a partnership if you're one person. There is a workaround on that where potentially 99% of the shares, if you're single, 99% of the shares are in your living trust. 1% is in your name. The IRS accepts that. That allows you to get the door, kind of shoehorn yourself into partnership status. And the S corp, this saves on self-employment tax potentially. And the C Corp is strategic for reinvestment. That's where the QSBS, Qualified Small Business Stock, which we cover in other webinars. So if you're starting a tech company, a lot of these tech companies are qualified small business stock. That exempts now $15 million in capital gain if you hold it for 5 years. The IRS doesn't tell you how to file. You're on your own on this one. And I will tell you, a lot of times, if you go to a CPA to get an entity done, the CPA says, oh, do an S Corp. And if you go to a lawyer, the lawyers say, do a partnership. I think it really depends on what you're doing. Again, operating companies tend to be corporations, entities, LLCs that hold capital assets like real estate, equipment, or whatever it might be. Those tend to be partnerships for the reasons we have, again, for the adjusted cost basis and more flexibility. Disregarded entity, again, no federal income tax return, only state income tax return if it's an LLC taxed as a disregarded entity. There can only be one person. California, because we're a community property state, if two spouses are on an LLC and they're married filing jointly, that can still be a disregarded entity. But if you're in Colorado or Oregon and two spouses are on, it will be taxed as a partnership. So a little bit of state variation in there. Being taxed as a partnership means you have to file your Form 1065, that is the partnership return, and a state income tax return as well. Again, very common for real estate. In California, the LLCs are subject to a gross receipts tax, and the maximum is around $12,000, $13,000. If an LLC is taxed as an S corporation, this requires filing the Form 1120S, the federal form, as well as a state income tax return. Now, there's no federal corporate tax due or payable by each shareholder. That's reported on their personal return. So the S corp say, hey, we made $1 million in profits. We're going to distribute this $100,000 in profit to a 10% shareholder. That shareholder has to pay $100,000. That's deemed $100,000 in income to the shareholder. They might have to pay $37,000 in federal tax. What most corporations do is they will distribute enough money for the person to pay the tax. So that's very common. And then you can also be taxed as a C corporation, where the corporation pays tax at the corporate level, and then you as the shareholder pay tax on the dividend. So if you own Apple stock, they pay corporate tax, and then you get a dividend from Apple, and then you're going to have to pay that on your own personal income tax. So you're taxed twice. There are use cases for a C corp versus an S corp, believe it or not. But that's the difference between the two. In most cases, in most of the time in our practice, LLCs do not pay income and capital gains tax on their profits directly. It's paid by the members who reported on their individual return, and the gross receipts tax. If your revenue is under $250, it's $800. If it's $500,000 or below, it's $900, and it goes up to $11,790. California does have the pass-through entity tax. So if let's say you make $1 million a year in a LLC, you can pay just under $100,000 to the state of California as your tax. You get a credit. You pay it at a flat 9.3% return, the 9.3% rate. You get a corresponding $100,000 federal income tax deduction. So you reduce your taxes by 37%. That is the pass-through entity tax. PTET is the acronym for that. And if this is all new to you and you're a business owner in California, get a CPA. And if your CPA is not doing this, I don't want to tell you to start looking for a new CPA, but this is pretty basic stuff for business owners. And it's rare that I see somebody not doing the pass-through entity tax that should otherwise be doing it, but just something you pay attention to. There's an extra L in there. LLCs simplify operations, less formal than a corporation. There's no board. There are no shareholder meetings, no board meetings, no annual meetings, straightforward setup and annual compliance. This is perfect for the busy entrepreneur who wants protection without a bunch of red tape and, frankly, a bunch of extra legal fees, quite honestly. LLCs offer ownership versatility. They're flexible. You can have one or more members. They're flexible for family ventures, partnerships, and trusts. They're very good vehicles. The LLC agreement can have terms that say, when is somebody admitted as a new member? If somebody gets divorced, so let's say I'm in partnership with Art Vandelay, we're mowing lawns, and Art gets a divorce, and that's community property. I don't want it to be 50% me, 25% Art, and 25% his ex-spouse, right? So you can have provisions in there that say if someone gets divorced, the ex is not going to be a partner. I don't want that, right? Of course, I might want it. I might not want Art as a partner. Who knows, right? Members can be people. They can be corporations or other LLCs. It's great for succession planning and estate planning. So LLC is, I would say, the preferred vehicle. LLCs do attract investors, partners, and lenders. So this is really important. A lot of people will say, Jim, I don't want to pay this $800 a year minimum franchise tax. And in my mind, I'm like, you know, you have a $50 million net worth. I think it's not going to break the bank on that one. Be that as it may, some people, it really annoys them to pay it. I get it. Doesn't matter how much money you have. It's just going to bug you. And some people say, can I do a trust instead? Can I run my business with a trust? Now, there are two caveats on that. Number one, the state may treat that as what's called a Massachusetts business trust anyway. That predated LLCs. It was kind of what LLCs do. These business trusts did. You're still going to have to pay your gross receipts tax. Trusts typically don't pay gross receipts tax, but if it's a business trust, it does. And they'll find out. Just I'm not going to get into how they find out, but they'll definitely find out. The other thing is, okay, well, it's not a business trust. It's just a trust. I'm going to do business with a trust. You need to talk to your lender before, if there's debt on the property. If you're getting a loan, lenders really don't like lending to trusts, and insurers really do not like insuring property that's in a trust that really should otherwise be in an LLC. And the reason is trusts they vary wildly on their terms. LLCs, it's an LLC. It's authorized by statute. It's a much narrower field of view, if you will, for the lender, for the insurer. So LLC versus kind of trying to avoid that $800 minimum franchise tax, I'm not seeing a benefit there. You just got to suck it up and pay the $800. The LLC does show professionalism, does show credibility, not just a side hustle. And I think this is really important with vendors. So certainly if you're operating a business, many people who are independent contractors, certainly in California, if you're doing speaking engagements or you're doing consulting, many companies require the person who is doing that consulting to have some type of an entity. Most people are using LLCs, many times taxed as an S corporation for a variety of reasons. This makes it easier to bring investors or partners in safely. You can assign or sell interests without blowing up the whole business. And a trust would be really difficult to do. LLCs create privacy and anonymity in certain states. States like Wyoming and Nevada don't require public listing of members. Okay, you keep your name off public records, and it's a simple way to add privacy and deter lawsuits. So many famous people will have their property in an LLC. Many wealthy people have their property in an LLC. What can't an LLC do? It cannot protect you from your own negligence. And I sound like a broken record on this, but if you do something, you're on the hook. It can't fix bad bookkeeping or commingling. So don't use the LLC as just your piggy bank where money's coming in and going out and you're really not paying attention. This does not replace insurance or other proper planning, and you do need formal maintenance, bank accounts. Well, you don't need formal maintenance. A corporation, you do need minutes, but you do have the filings that you have to do with an LLC, certain filings. So how do you use an LLC? Well, when not to use an LLC. This is really important. If you're watching this and you're a lawyer or a doctor, professionals cannot use LLCs in California. Physicians, lawyers, accountants, real estate brokers cannot use LLCs. We must use corporations. It must be a professional corporation. Now, this is not the same in every state, but in California, you just can't use an LLC for a professional corporation. When can you use an LLC? If you're, again, independent contractor services, small business, management of personal investments. Typically, it's taxed as a disregarded entity or partnership potentially. Real estate investing, and that is rarely taxed as an S corp. And you got to be careful on that because you're going to be signing a lot of paperwork. And the caution is if you go to a CPA, many times the knee jerk with the CPA is to have it taxed as an S corp, and they do know better. They do know that the LLC that holds a capital asset should probably be taxed as a partnership or disregarded entity. But that's just a little word of warning. And this is the benefit of listening to someone who's been in practice 30 years. I see these patterns over time. So that's just something to pay attention to. All right, LLCs for real estate investing. These are recommended for residential 1 to 4 units. Recommended, but it depends on the unit, okay? It depends on what's going on. I would say this is essential for commercial properties. This would be office, retail, industrial, multifamily. Multifamily is residential, that's 5 or more units. There are just too many risks on commercial properties. And even if you have a duplex or any kind of rental, you might be taking excessive risk by not having that inside an LLC, essential for ranching and farming. If you have a ranch or a farm that is in your name individually, you are taking a crazy amount of risk. There's so much liability that's associated with ranching and farming, and just in terms of personal injury. People get hurt, and it's not your fault. And if they're your employees, you're going to be responsible. Okay, so it's really something to pay attention to. The LLC for real estate investing provides asset protection, isolates liabilities, provides a structure for accounting. When you file a partnership return, you're filing a balance sheet, right? So you have to maintain a certain level of professionalism, and that just really helps run the business. And flexibility in management and distributions. Okay, limited liability. Let's talk about reassessment. Prop 13, Prop 19, really not so much Prop 19, this is more Prop 13. When property is 100% reassessed, when an LLC acquires the property, the LLC becomes the original owner. Instead of the individual human being owning the property, the real estate's 100% owned by the LLC, and the human being owns the LLC. There's original owner LLC, and there's non-original owner LLC. This one is going to blow your mind. If you're an original owner of an LLC, so long as control doesn't change hands from you in this example. So if you own this LLC 100% and you buy this property with an LLC, that property is reassessed when you buy it. So long as control does not pass to somebody else, meaning someone gets more than 50%, and so long as nobody gets more than 50%, this property will never be reassessed. Disneyland will never be reassessed. A bunch of property that Chevron owns will never be reassessed. The Irvine Company owns a bunch of property, never going to be reassessed. This, folks, is crazy because you walk down a street in California, it is not uncommon for one person to have a $2,000 property tax bill and the exact same house next door, that property tax bill is $20,000. I personally think this is grossly unfair. It is grossly unfair that these massive publicly traded corporations benefit from Prop 13, but hardworking families don't. Okay? So this is an end run around it. Now I will qualify this. This is not for your home. This is going to be a business use asset. Okay? Other people, this property can pass from you to your 3 kids. And so long as no one has control, the property's not going to be reassessed. If it passes from you to 1 kid, one person's gotten more than 50%, that property will be reassessed. So if done correctly, never reassessed. So other benefits that other than Prop 13, an LLC provides limited liability. The creditors of the LLC can only go after the assets of the LLC, not the members' personal assets. Structured properly, the members' personal creditors cannot go after the assets of the LLC. This is very important. California, if you have an LLC and you're a member of this LLC and you own shares and there's outside liability, you get in a car accident, okay? That creditor can foreclose on your LLC shares because it's a California LLC, can foreclose on your LLC shares the same way a bank can foreclose on your property if you don't pay your mortgage. Now, this is why it is very important. If you have a California LLC, it's very important that you have buy-sell provisions in there. It's very important that you say, look, if a creditor comes forward and there are multiple members in this LLC, that creditor is not going to be a member of the LLC. Now, they might be able to foreclose and crack open that LLC and force a sale, but we really don't want that person becoming a member. If you have an LLC with no operating agreement, no provisions, zero, you do it on the cheap, right? You do it for $75 at the Secretary of State's office, and you have none of these other provisions, I think you're in serious trouble. A better way is for, and we're going to talk about this in a little bit, if you have a California property, you put that into a California LLC. The shares of that California LLC go into a Wyoming LLC. Now, you may think it's a bit of a shell game, but really it's layers of protection. Wyoming, as we're going to see, has significant protection for outside creditors. So this is, you get in a car accident, you cause a lot of liability. Can that creditor get to the shares of your Wyoming LLC that owns the shares of your California LLC? And we're going to see the answer is likely no. Okay. So Wyoming, for example, allows for protection of creditors from creditors of the shares owned by the individual. This applies only to prospective and not current creditors or claimants. This is very important. So if something's already happened, you know, there's nothing our firm's going to do for you. Limited liability company at death. The LLC membership interest can be transferred at the owner's death according to the terms of the operating agreement. So the operating agreement may say that the company buys back the shares, or that, you know, this other member buys the shares, whatever it is, or the estate planning documents, or both, or based on intestate succession. Now, we cover that in other webinars. That's if you don't have a will or don't have a trust. If you have an interest in an LLC, you do need an estate plan. I'm just going to tell you straight up. You do need an estate plan. You don't want that LLC share to end up in probate. The LLC operating agreement can also include rules about how the real estate is to be used and managed. So example, Hal and Wanda create HW LLC, Hal and Wanda LLC. Hal and Wanda put money into the HW LLC and get shares in exchange. And they put, then HW LLC buys Greenacre. In 2050, which is 25 years from today, and if somebody is watching this in 2050, we're doing this 25 years ago. I don't even know if this is going to be on YouTube in 25 years. In 2050, when Greenacre is worth $5.7 million, the assessed value is $1.775 million, and the property taxes will be $17,000, not $57,000. So in 2050, when Hal and Wanda pass away and this property passes to their children, the children keep the $17,000 property tax bill, not the $57,000 property tax bill. That's because your property taxes can only go up 2% a year, but the property on average in California goes up 6% a year. Whether it will go up 6% a year over the next 25 years, who knows? Use of Prop 13 compliant LLCs to hold real property. This is very important. If you hold real property in California, I beg you, please consider purchasing the property. When you go to buy a property, consider buying it with the LLC. That gives you original owner status. Well, when the owner dies, if the property is not reassessed when it goes into the LLC and you're not the original owner. So let's say Hal and Wanda don't buy the property with the LLC, but they buy the property and then put it in the LLC, and it's not reassessed when it goes in the LLC. If Hal and Wanda own it 50-50 and they transfer it to an LLC where Hal and Wanda own the shares 50-50, that is not deemed a change in ownership. So the property, typically when it goes to an LLC, if you buy it from somebody else, that's a change in ownership. Property's reassessed at its fair market value. But if you already own the property and you transfer it to an LLC and you own the shares of those LLCs in the same proportion that you did the underlying real property, there's no reassessment. So if Hal and Wanda put this property into the trust after buying it and then die, the property taxes at their death in 2050 go from $17,000 to $57,000, right? They're not going to stay at 17. So that's a real important benefit. That's a $40,000 a year tax benefit over maybe a 20-year period. That's almost $1 million that the family, right, would be out of pocket and paying the taxes, versus had Hal and Wanda done some good planning from the get-go. Airbnb. Hal and Wanda create a Prop 13 compliant Hal and Wanda LLC. Hal and Wanda LLC buys a vacation home for $1 million. They rent it out for short-term rentals via Airbnb. Now the home's worth $3 million. When the three kids inherit the shares, each acquires a 1/3 interest in the LLC. No change in ownership. The property, again, must be acquired by the LLC, not transferred to the LLC after purchase. And the Prop 13 compliant LLC, what this is this says nobody can get more than 50%. No one can have control. So these are some provisions we put into the LLC, very important provisions. But what we say is any attempted transfer that would result in this person owning more than 50% is void ab initio. So it is not valid. It is a violation of terms of the operating agreement and the other provisions control. So this is well thought out for us. And this is kind of a safety valve that keeps you from getting reassessed. Now, let's see, in our example here, continuing, Hal and Wanda create this Prop 13 compliant HW LLC trust. They buy the vacation home. Son gets 49%. Let's say if there's one kid, right? So in our other example, we had 3 kids, right? So if we have 3 kids, each kid gets a third, no problem. But let's say there's only one child. I happen to be an only child. You may be an only child as well if you're watching this YouTube video, right? Hey, birds of a feather flock together. So what can we do? The son gets 49%, the daughter gets 49%, the grandkids get 2%. That is if you like your daughter-in-law. Now, I don't know. Some people do, some people don't. It's up to you. But that's a way. This is no change in ownership because no one's gotten more than 50%. And that's a safe way of doing it. Maximum LLC protection. California LLCs offer little outside creditor protection. When I mean little, it's basically none. California law allows creditors to foreclose on a debtor's membership interest in an LLC with the use of court judgments. This stinks for single-member LLCs that have no other partners to prevent the complete liquidation of the company, and for multi-member LLCs who want to distribute assets out to the other members of the LLC. So if Alpha and Bravo put their $1 million portfolio into a California LLC, the creditor can foreclose on Alpha and Bravo's membership interest and get the $1 million. This does not happen with a Wyoming Close LLC. A Wyoming Close LLC holds shares of a California LLC and acts as a holding company. So what you can think of as it's an umbrella. And under this umbrella are a lot of little LLCs. And the shares of the LLC are not owned by Hal and Wanda, or Alpha and Bravo in this case. The shares of the LLC are owned by the Wyoming Close LLC. Now, so what this requires is filing an LLC in California. This also requires filing an LLC in Wyoming. There is no separate LLC filing for a Wyoming Close LLC. This all happens in the operating agreement of the Wyoming LLC. And I will tell you, I recently met with a client who says, I've got one of those Wyoming LLCs. I'm good to go. I looked at the operating agreement. It was not a Wyoming Close LLC. There was no protection. It was a regular Wyoming LLC. So this is very important. This is a subset of LLCs under Wyoming law. And how you get the good stuff for the Wyoming Close LLC is in the operating agreement. Remember I said LLCs aren't required to have an operating agreement. Well, if you want the asset protection, you better have a really solid operating agreement under Wyoming law. And this is what we're going to talk about. So an example, Alpha and Bravo own Greenacre, a 25-unit apartment complex. The dirt, bricks, and sticks of the apartment complex are owned by a California LLC. It's very common. If the property's in California, we're going to be recommending likely that the client create a California LLC to hold that California property. So the shares of the California LLC are not owned by Alpha and Bravo. The shares of the California LLC are owned by the Wyoming Holding Close LLC. Alpha and Bravo's living trust owns the shares of the Wyoming Close LLC. Alpha and Bravo now have what is called charging order protection from outside creditors to protect their equity in Greenacre via the Wyoming Close LLC. Now, I'm throwing a lot at you, and what we're going to do is I've got a graphic here that kind of shows you how what the structure is. The holding company, which is the Wyoming Close LLC, typically is going to be taxed as a partnership 99.9% of the time, owns the shares of these various disregarded entities. Now, even if each LLC has $3 million in revenue, you're only going to pay the $800 minimum franchise tax. If these people are California residents, you're going to pay the full boat franchise tax on the holding company. So again, we had another client come in about a couple of years ago. We made a referral to a very qualified CPA firm. The CPA said these people are overpaying on California minimum franchise tax by about $30,000 a year. So we saved them a significant amount of money. So just a little side point: you're not paying the full franchise tax on all the LLCs. You're just paying that minimum. You're paying the adjusted franchise tax or the full boat tax on the holding company. So holding company LLC. We've got these three disregarded entities all roll up to the holding company. So this two-layer cake is really a smart structure. The California LLCs own the actual properties, the dirt, the bricks, and the sticks, or the business, right? And I think this is required if you're operating under California law. You're going to have to register in California. You might as well have a California LLC. Could you just go directly to the Wyoming LLC and not use the holding company structure? I think it's a weakened creditor protection, and I'll tell you why. If that real property is located in the state of California, that California judge is always going to have jurisdiction over that property. And they go, I don't know what this Wyoming LLC is. I'm not really paying attention to it. I'm awarding the property to the creditor. When the shares of the LLC are owned by the Wyoming LLC, that creditor may have to go to Wyoming to enforce the judgment. So very, very important to understand that. The Wyoming LLC owns these membership interests in California. If someone sues you personally, they can't break into the Wyoming LLC. They're stuck with charging order protection, and I'm going to explain what that is. If somebody sues your business, the damage stays inside the California LLC. Your personal wealth is designed to keep your personal wealth safe. So what is charging order protection? When an LLC is organized under the laws of Wyoming and the operating agreement contains very specific provisions, a personal creditor cannot break into the Wyoming Close LLC to satisfy a judgment. The creditor's sole remedy is what is called a charging order, which is relatively weak. So what this is, what a charging order is a court-authorized lien brought by a creditor on distributions from the Wyoming Close LLC. So it's very important. The creditor does not get ownership of the LLC shares the same way that a creditor gets ownership of LLC shares in California. Remember the example I used of let's say you have a mortgage with a bank and you don't pay that mortgage payment. Well, the bank can foreclose against your property and take the property. That's the same thing that happens in California. Under California law, a creditor can foreclose on your California LLC interests. Under Wyoming law, with a close LLC, they cannot foreclose on the interest. They are only entitled to payment when other people get paid. Okay? So, and they can't become manager. So you've got a manager in place that says, I'm not going to distribute anything to anyone, and the creditor gets taxed on the activity that's occurring inside the LLC. So let me say this again. Charging order protection does give a creditor theoretically some benefit. It's whenever money is distributed, the creditor gets it, but the creditor also gets what's called a K1. Now a K1 means, hey, this person's share, this creditor's share made $1 million. That creditor is going to have to pay income tax on $1 million, and they're not going to have any money distributed. That's charging order protection. That brings the creditor to the table to negotiate, to make a very favorable deal to the debtor, the person who owes the money. So there's not a lot of case law on this, I will tell you. It's because these cases tend to settle. Because there's not a lot of case law because people really aren't successful on this, right? The creditors aren't successful in going to court and cracking open these LLCs. What they need to do is they need to go to the negotiating table and work it out with the debtor. So only when distributions are made is the creditor paid. Very, very important. So here's an example. Before Charlie's accident, Alpha and Bravo put their $1 million stock brokerage account into a Wyoming Close LLC. Alpha and Bravo follow all applicable rules, create appropriate documentation, follow the formalities, and generally respect the rules, not set it and forget it. When the creditor looks to seize the $1 million portfolio inside the Wyoming Close LLC, the creditor is limited to garnishing. You can think of it as garnishment of distributions to Alpha and Bravo. So if there are no distributions, the creditor gets no money, but they get a tax bill. That brings us to the end of our materials here. Is consulting with a lawyer enough? Well, I think you need to assemble your A-team, and this is the A-team from the 80s with Mr. T, okay? Not the recent one. I didn't even watch that one. Who's on your A-team? It's a three-legged stool. It is your specialized California trust and estate lawyer. So a savvy estate planning attorney. I wrote the book, Savvy Estate Planning, What You Need to Know Before You Hire the Right Lawyer. It's available on our website and at Amazon, and we cover many of these issues. I would say a CPA. So if you're doing an entity, getting a CPA makes sense, and a certified financial planner, ideally, or another financial advisor. You need those. That's a three-legged stool to do the planning properly. If you're watching this on YouTube, please subscribe to our YouTube channel. Hit the share button. We really appreciate it. And if you enjoy our webinars, also review us on Google. Just say nice things. Hit 5 stars. Thank you very much. And next webinar is taxes, maximizing charitable giving and cutting taxes. So we are recording this particular webinar in late 2025. And in October 23rd, 2025, I will be doing this with Christina Lindsay Orta at Ascent Wealth Management. And you can register at our website, and there'll be a link in the notes. These are our offices throughout the state of California, Northern and Southern California. And this brings us to the end of our time together. Just if you're watching this on YouTube, keep watching. Another video is going to magically roll right after this one. And check us out on our website to sign up for a webinar, because I'm going to answer a bunch of questions live that we won't post. We'll see you soon. Thanks for watching.